Welcome to Finance with Factor,
Oops, apparently we're already recording, so here we go.
a place you can come to laugh and learn from local experts who love to discuss everything related to the world of real estate.
Weird passion. It's one that I actually share a little bit, so it makes me a weirdo with you.
Each week, we'll cover a unique topic
Let's talk about condos.
to help you understand the mortgage industry, navigate the home buying process, and grow your business while maintaining a slice of sanity.
Okay, fine. I've been confused by a lot of things over the past few years.
Now that he's climbed safely atop his soapbox, here's your host, a senior loan officer with Movement Mortgage, Jason Factor.
Thank you, everyone, for joining for this week's episode. This one is a little bit different. We talk about all kinds of things on this podcast, but we haven't talked about them for a little while because I've taken a couple of weeks off from my usual weekly stream due to some things I was running for in town that will have to go unnamed here on this podcast for compliance reasons. But I was running for an elected position in town. Does not conflict in any way with what I do here on my full-time job, which is not podcasting, it is mortgage lending. And I did win that election, but now I have time to focus back on the things that bring me extra joy, which is things like this podcast where I get to talk to friends, industry professionals, and people who provide some value to real estate related conversations that are going on that are relevant to you, your business, and your home buying process. With that said, I wanted to invite on a friend who is joining as an also independent citizen today. Professionally speaking, Michael is a commercial mortgage banker. I will not necessarily mention where because, like I said, today he is joining as a private citizen, but that is important because what we are going to talk about today is something that keeps coming up in a lot of conversations and a lot of news streams and a lot of headlines that Michael has some insight to on the commercial side. And I wanted to pick his brain on how it could even work on the residential side or what it would mean and define some of the terms. So without any more cloak and dagger vagaries, welcome Michael Chase to the podcast.
Jason, always a pleasure to speak with you. Thanks for the opportunity to join here today. As you mentioned, I'm a commercial mortgage banker. And yes, the comments that I make today are not representative of those of the firm I work for. Because, if we should say anything controversial, I don't want anything to go back to that. These are all my own private, thoughts and insight.
So what is it that we would like to talk about today? I alluded to it loosely, but the term that you hear on everything from Fox News to MSNBC to places like the Wall Street Journal is the term collateral swap. Now, the reason that you hear this is because it is a legitimate thing, particularly on the commercial side, which is where a lot of the people that are running the administration's real estate policies have commercial backgrounds. And so you keep hearing it pop up over and over again. But it isn't a thing on the residential side, at least yet. So let's start with the brief definition. Michael, what the heck is a collateral swap? What does that mean?
Sure. Also known as substitution of collateral swap, is when you have a loan, it's encumbered by a piece of property or an asset. In your residential case, it's your home. And let's say you wanted to move, you could bring your mortgage with you and you could change the collateral that's backing that mortgage from your existing home to the new home, basically swapping out one piece of real estate for another.
How does that work on the commercial side? Walk me through when you have a client who wants to perform an asset swap or collateral swap. How does that work?
Sure. And the interesting thing is we have it on the commercial side, and yet the way the residential market works, you would think it would be more popular or more common on the residential side. So back to your question, how does it work on the commercial side? So a borrower has a loan on a commercial piece of real estate, an income producing piece of real estate. And instead of paying that loan off, they ask their lender, hey, I'd like to take this loan and potentially move it over to another piece of collateral, another piece of real estate. We would underwrite that real estate. And so long as that new collateral is equal to or better than the prior collateral, you could potentially move that mortgage over. And so the collateral backing that loan would be the new piece of real estate. Now,
Typically, when you sell, when you buy, I'm just going to use like an office space or something. I'll use a small like doctor's office space just as a random example. But you have doctor's office A and they're going to move to doctor's office B, which is bigger. They have a small mortgage on doctor's office A and they lock that in at whatever percent back in the day. And that's way better than what they could get today on office B. So what they want to do is, instead of selling office A, closing out that loan, and then opening a new one on office B, they are going to take the loan from office A, move it to office B, and you'll underwrite it as its existing thing. Now that might be, if they're selling a place that's $500,000, they have a $200,000 loan on that, and they're buying $1 million office B. That means they now have to bring $750 to that purchase to make up that difference and carry the existing loan, correct?
That is generally correct. There also could be an opportunity for subordinate financing. There could be a second mortgage. There could be other capital added to the stack that, blended together, might still be more attractive than a current higher rate.
Which would make sense, right? Taking out a $200,000 loan at even 10%, but you have your primary at a lower rate for the larger portion, might still add up to a blended rate that makes sense.
Right. Now, I will caveat to say, on the commercial side, we see this most commonly happen in a portfolio loan basis. For example, you have a borrower that purchased multiple properties, and many of those properties are under one or collateralized under one note. But they built in an interest-only piece of that loan, and they want to be able to swap properties in and out. So they can manage that portfolio and take individual properties in and out from that loan and trade them so that they can keep the overall loan intact. So it's more common on a portfolio side, but if you have a forgiving lender and a good sponsor, it is possible on an individual basis as well.
Which is something that we don't have on the residential side, really. We don't have that for individual borrowers. Typically, you don't have multiple properties under one note. Think of it like, for those who are having some cognitive dissonance and their mind seems kind of confused and blown. Think of it like your 401k. Your 401k has lots of stocks and bonds and investments in it. And those stocks, bonds, and investments flip in and out throughout the lifetime of your investment, but it's still your 401k at X number of dollars that have been invested. So that portfolio product that Michael's talking about, the properties themselves are like the individual bonds, stocks, and trades that are happening within your overall portfolio.
Right. But if you don't mind me, Jason, let's take a step back and get into why are we even bringing this topic up? Home buyers since 2023 have had this struggle, right? There's increased competition for a very limited supply of houses out there because people who are locked into these low rate loans, they don't want to put up a for sale sign. They don't want to trade up to a current mortgage, right? So the culprit here is what we refer to as the lock-in effect. We probably already know friends, family, or whatever. They'll tell you, they'll have to drag me out of this house by my boots before I give up my 3% mortgage, right? FHA, the Federal Homeowners Association, they tell us that as of 2026, early 2026, just over 50% of the outstanding mortgages out there have a rate of 4% or less. That's a lot of loans out there that are basically frozen in place. And we've got politicians, we've got advocates that are kind of playing around the fringes. They're instituting policies to try to encourage people to move on from these low rate loans, maybe use their 401k or do some other things. But they're not really attacking the issue, which is, hey, there's a lot of these low rate loans out there and people just don't want to give them up. They're going to hold on to them and they're going to freeze the market and they're not going to put their houses up for sale because they're not going to want to trade out of them. And we're talking about a nearly $14 trillion marketplace here. Maybe it's 13 trillion, but still 13, 14, what's a trillion between friends? But still, it's a very large market. And if you're talking about nearly 50% of those mortgages below 4%, it's just, it's a significant part of the market that is locked in. That's a lack of supply, which means driving up home prices, it's limiting availability for new home buyers. So how can you unlock that supply of housing? How can you get people to want to move? And it's a very simple solution. And it's kind of sitting there with allow people to substitute their collateral.
I see this in two particular segments of the home buyers or homeowners out there. One is the homeowner with the growing family that feels kind of stuck in the thing that they thought was just the starter home that they bought during COVID at 2.5, 3.5, 4%. And then the other one is the person who needs to downsize and is in the big home that they can no longer really afford. But what they really can't afford is today's rate on the new home. And so you have these populations that feel sort of stuck. And I see that, right? And now from a residential lending standpoint, it's about sitting down and talking through the budget and saying, what's the pain point that makes you feel uncomfortable? And let's work backwards from the monthly payment and the out of pocket costs. And maybe we have to settle a little bit on the house to make sure that this stays on budget and affordable. But this concept of asset swap keeps coming up, or collateral swap keeps coming up, at least in mainstream topics and headlines, as, oh, this is coming down the pipeline to save the day. And I mean, I don't know that it is. I rely on smarter people like Michael to tell me that stuff. But Michael has written an op-ed piece or drafted an op-ed piece that I've taken a look at. And so I just wanted to kind of pick his brain on it.
Yeah, thank you again. So I think it makes all the sense to consider this as a real option for helping to unlock the housing market, helping to create additional supply for buyers, helping those borrowers who feel that they may be stuck either in a house that they've outgrowing, or like you said, a house that they really should be downsizing out of, freeing up that inventory for new buyers, and at the same time giving them the option to move and not impact or have as great an impact on their own spending power. I mean, residential lending has a social impact piece to it that commercial lending doesn't really have. The public,
You mean commercial lending can be cold?
well, it's just commercial lending is truly investment real estate, right? And we see this in just how the mechanics of a residential loan are done versus a commercial loan, right? When we're doing a commercial loan, we underwrite the property as the source of repayment. What are the tenants paying? What are the operating expenses? What's the NOI? What type of loan can that property carry? When you apply for a residential mortgage, it's the borrower that's carrying that loan. That's why you can get pre-approvals and pre-commitment before you even have the house identified, right? You can work with a person like Jason and he can tell you this is the loan amount you qualify for. And then so long as you find a piece of real estate that appraises for a certain value, you can go and you can get that home loan. But it starts with the borrower, right?
And I should add 2.5 caveats to that. One, there are some what we call transferable mortgages. So particularly on the government side, your VA and some FHA, some
Right.
USDA loans, depending on how they're underwritten, can be transferred to the next buyer. So again, it's sort of the inverse of what Michael's proposing that we discuss here today, but that is the loan is tied to the property, and then the new buyer can assume the loan that is on that property. And you might see that advertised. We see that movement happens to be very big on VA loans, particularly down in South Carolina where we're headquartered. And so in some of these military communities or high density military communities, you do see a lot of these transferred loans
Right.
where the loan itself gets advertised as like, hey, this house has a 2.5% mortgage, come buy it. And then the sharks circle and try to buy that house. The other one that I should note where Michael is saying the house is underwritten, not the borrower, would be the HECMs. So the home equity conversion mortgages, which are commonly referred to as reverse mortgages, which I'm seeing become a very popular product for people that do want to age in place, tap into that equity. And that's a whole nother conversation that we will have coming down the line. But that is another one where we underwrite the property that you're either buying or currently living in and not the borrower really, because it's the property that's guaranteeing the value.
Sure. But let's take that first part, the assumption, the assumable loan. it's amazing that you have a part of the market that does allow for that. The VA, USDA.
And the other one that I will say is sometimes all of these rules, like anything in real estate, all of these rules are negotiable. You will sometimes see it in you mentioned the word portfolio. Some of our wealth management assets. The only time I've ever really seen um, assumable mortgages in the way that we're discussing here is when where the collateral itself gets swapped is when it's underwritten by a wealth management or um, private wealth asset.
Mm.
So, in other words, sometimes people will leverage their own money to purchase something out using their wealth advisor. They will take a loan against their own portfolio wealth. And then again, similar to what you're saying, like the property itself, not super important as to what you're buying. I mean, it is, but what we're leveraging is your own money in that situation. So that the underwriting guidelines can be a little different.
So going back to assumable, when you're changing the borrower, you're changing the source of repayment. So it's amazing you have a portion of the residential mortgage market that allows for assumption where you have the borrowers changing, which is really a change of the credit, but you don't have substitution of collateral where you're maintaining the same source of repayment and you're just changing the asset and saying, okay, as long as I have an asset that's equal or greater value, that I can continue to have this mortgage. It's not as if these assets don't change or homes don't change, right? You get into your home, you do renovations, you do additions, you can change the collateral. In fact, we see that happening today. You have these homes where families are kind of growing out of them, but they have ultra low mortgage rates. So what are they doing? They're going taking a home equity loan or second mortgage. They're doing additions. They're changing that collateral. So what is the difference of doing an addition, doing a renovation on that home, changing that collateral, or just swapping it out and buying a bigger home down the road?
I think it's a totally fair question. And I don't know the answer. I also think that the real part of the complication to all of this, like everything in real estate in the world these days, is private wealth. It's Wall Street, right? So all of these loans are commoditized on Wall Street. And these dossiers of files that are collected on each borrower on each property are put in some packet somewhere and shipped off and collateralized and sold on Wall Street and bundled up together in a way that I think divorcing them of the asset can be extra complicated, perhaps. But I don't, it doesn't mean there's not a pathway to it. What do you see when you kind of when you tried to model this out and think through this? What were some of the hurdles that you foresaw, or what are the conversations you're hearing
Right.
that maybe from your experience on the commercial side you could apply to the residential side?
So you're absolutely right. A majority of these loans are packaged. They become what are called mortgage-backed securities or MBS, and they get sold out to the market. And then that paper gets packaged up again and resold and creates a lot of derivative products off of that. So there are complications with kind of messing around perhaps with the underlying collateral that go again, we just talked about a scenario where people are able to renovate and change their homes. So it's not as if these assets have to remain unchanged or untouched for the life of the loan. But you're right, there are some complications with these MBS. But let's set that aside for a moment. We'll come back to that. 70% of those loans are securitized in MBS. Remember, it's a 13 trillion dollar market. There's 30% of them, the jumbo loans, the non-qualified ones that are held in portfolio by certain banks and other lenders. Those loans are not subject to those same Wall Street, REMIC, Security Exchange type of regulations. Those are just under the auspice of purview of that lender who's holding that loan in portfolio. Now, they might have other investors who've done some other things with the paper, but in general, they have the decision-making ability on that market. So if you say, let's say 30%,
Just deferring that term real
yeah,
quick. So Fannie Mae and Freddie Mac are um, semi-private government-sponsored entities at this point, and then FHA is a fully sponsored government entity, which would also include VA and USDA loans. The jumbo market, so FHA, Fannie Mae and Freddie Mac, USDA and VA, they set what are called loan limits. Anything above those loan limits. So, for example, they understand that buying a house in rural Mississippi is different than buying a house in Manhattan. And so they're saying, yes, that person who is buying, a single family home in the suburbs of Iowa is probably buying at a different price point than the person buying in the suburbs of San Francisco or LA or New York, Miami, Boston. So they create what are called high value loan limit areas where you can exceed that limit a little bit and increase it. So for example, in Massachusetts and in the high limit areas, there's a random number that it goes up to. I don't know it off the top of my head. I probably should. But the moral of the story is anything under that loan limit becomes a conventional loan. Everything over that loan limit becomes a jumbo loan. Those jumbo loans are generally written, held, and serviced in-house by the lender who is underwriting that collateral. And so those are the types of loans that Michael's saying might have some flexibility to apply some of these right now theoretical concepts.
Exactly. That's 30% of the market. That's roughly $4 trillion out there of these mortgages that are being held in portfolio by these various lenders. Again, you take the idea that say 50% of that is still under 4%. That's $2 trillion out there that could be worked on that has the local decision making control. We've had conversations with the CIOs of certain banks that will remain unnamed, and we posed this idea to them. We said, "Hey, you love your clients, right? You love your borrowers. You want to maintain that relationship with them. Why not give them this ability to swap their collateral?" And these are lenders, these are banks that are sitting on portfolios, hundreds of millions of dollars of residential loans. They're in their own portfolio. And the response was interesting. Some of them were, that's great. That sounds actually possible, but we're just not set up to do it. But if you hear someone else start doing it, let us know. And it just
Like everyone, I don't want to be first in line, but you don't let me be more than second.
exactly. So it kind of takes that first. It takes something to overcome that first. It's going to take some bank or some borrower or some group of borrowers to kind of force the hand and say, I want to be able to substitute collateral. And then for the news to get out. And then for these other lenders to realize, hey, this bank over here is now doing it for their clients. We got to start doing it for our clients. And then once that happens in the next bank and the next bank, and then eventually it'll move over to those MBS lenders because they're going to see that the private lending market is doing it. Now we have to give access to the rest of it. So
It becomes an equitability issue at that point. And right now the conversation is being held on Capitol Hill, which means it will go nowhere.
Exactly.
But the conversation is happening, at least in theory. It's probably just political midterm talking point conversation to sound like you're really pushing for something. And the reality is that even if things are announced, it doesn't mean it will be enacted. And I want to give that caveat because we saw this with credit scores, for example. They said credit scores now run on, this new way of collecting credit and all these things. And everyone looked around and was like, we're not set up for that. We can't actually implement it. It's cool that you tweeted that out and now it's a thing in guidelines, but nobody can actually do it, including Fannie and Freddie and FHA, the entities that you oversee. Nobody can actually enact this thing. So even if you do hear the headline, Michael's right. There has to be a system set up to apply the logic.
The politicians will tell you two things. One, the 30-year mortgage is an important asset to protect here for the United States of America because the 30-year mortgage is kind of unique for us. If you go over to Europe, they don't have the 30-year mortgage that on a fixed rate basis with no prepaid penalty. In Europe, your residential mortgage is floating. So when rates went up in 2023 globally, all those borrowers, they saw their mortgage rates just jump. automatically. They didn't get this locked in effect. So they want to protect that. And it's kind of like the Constitution. They'll tell you, well, if we go and change the rules and allow for substitute collateral and we change the 30-year mortgage, then what other changes might come that we don't want to have happen? I don't know. Not so sure. I mean, this substitute of collateral is such a good idea. I think it'd be worth it to go in and investigate. Hey, can we already allow for no prepayment penalty. We already allow for all these other things. It's kind of a consumer protection thing. It would allow again to free up the housing market. It would allow borrowers to maintain their spending power. So there's so many positive social aspect pieces to it. I don't understand the political angst against it. The other thing they'll tell you,
I would have to say that one thing that I'm sure causes some angst in the conversation, or at least should be thought through in the conversation, is that thing that we set aside before, the idea of the MBS market. So the mortgage-backed security market, keep in mind, the majority of your 401ks, so the way that your retirement packages tend to work at most of these big investors, so if you have like a Fidelity or a Vanguard, 2058 plan, the way it works is when you start out, you're in a much more aggressive portfolio. You might be trading international currencies and penny stocks and biotech, and you'll have all kinds of different stocks and things. As you start to get near retirement, your portfolio will transfer into a more what we would call stable portfolio. Um, and the MBS market has forever been seen as that stable investment because of exactly what Michael is saying, that those rates are locked on a 30-year fixed rate. And so I know exactly how they're going to perform. I know the rate of failure, and I know what is a good loan and what is a bad loan because they are very standardized.
so I was just going to get to that point, Jason. That second thing that the politicians tell you, one, we want to protect the 30-year mortgage. The second is we want to protect those bond investors, you know, so we can't mess with the MBS. We want to protect those bond investors. I have two counters to that. First, these loans are prepayable. We have watched rates drop, you know, over and over and over. The 10-year period, between 2010 and 2020 before COVID, you saw this constant decline. And what did people do? Why do we have so many so many loans outstanding with rates below 4%? Because it wasn't as if they all matured and then people refi. People just are able to refi. When rates go down, Jason's phone goes off the hook because they can automatically refi. So don't tell me these MBS bars are like, well, we signed up for that rate of return and it's going to be there for 30 years. No, as soon as rates go down, borrowers go and refi. They are able to follow the market down readily because these loans don't have prepay penalties. So protect the borrower. What are we talking about? So the other part, they say, well, we're locked in now on these low rate. If you want to help these MBS investors, allow them to generate some fees that get associated with these collateral swaps. You can't tell me that a person, if I could take my 3% loan from one property to another property, that I wouldn't pay 2 or 3 points for that right to do that. And that
If you
money,
tell me the current rate is 7%
yeah.
and 2 years worth of interest is $30,000 difference between what I would get today versus what I'm taking with me, I might pay 5 years worth of interest. It might make sense if I'm buying my forever home. That might be a good
So
investment.
those fees that you could charge that borrowers are be willing to pay in order to swap that collateral and maintain that mortgage, those fees could be distributed to those bond investors as an incentive to allow. Those fees could pay for all the transactional participants who would say, oh, geez, if we let this happen, then I can't get paid my normal. No, the lawyers will still get paid. The brokers will get paid because there'll be more transactions. The mortgage originators will get paid because they will have to be able to charge these points for the news. They'll be able to originate new loans on top if the loan is undersized, so they could do a note B. The other part, like you mentioned earlier, Jason, there is a significant part of the market that people want to downsize. So grandma who's living in the house, who's not able to put it on the market because she doesn't want to give it the 3%, she downsizes to a smaller home. She pays off a portion of that mortgage to right size it to the new home. That gets put back to the bond investors. So we see that portfolio of outstanding low rate mortgages shrinking from the people who want to downsize. So you have lenders out there who can generate new fees. You have lenders who can originate second mortgages. You have all the participants who can get paid for all these new transactions, and you're helping those MBS investors by either downsizing loans or participating in these other fees that can be charged, allowing people to swap. So it's hard to say that, oh, we're protecting these investors by not allowing this. In fact, you're putting them at a detriment because you're keeping these people have said, I'm not touching this loan. I'm keeping it till I die. So why keep those low rate loans in place and completely untouched without any return? Allow some ability to churn those loans, touch them, get some fees, generate income, and distribute that throughout the market.
And the most risky and difficult and expensive for a lender. Now I'm speaking as like corporate mortgage banker, which I despise. But I don't think anyone in the world has ever said, you know what I really love, a corporate mortgage banker. But the the reality is writing a new mortgage is very expensive. There's very little margin in it. So if you're going to this type of model that Michael's discussing here or theorizing about, I mean, those could be really profitable loans for the lender because you don't really have to underwrite anything but the collateral. So you could turn them really quick. Quick loans are cheaper for the lender to originate, and you could charge pretty high fees because it's a pretty specialized product. So, I mean, outside of being predatory, I'm not talking about being predatory, but you can kind of set your own market and cost expense to make sure that the back end still lines up in a way that honestly, I don't know the metrics of how you get them going, but when you say so, I have an old say it out loud principle with files where Mandy, the other loan officer on my team, will just say something out loud and we'll be like, did that make sense? Yes or no? Would you push an underwriter to approve this? Yes or no, based on saying it out loud? And if the answer is yes, then we fight for it, right? If we say this all just makes too much sense to hear no, then we fight for it. We find an exception. We find a way to get it done. This feels kind of like something that makes a lot of sense.
It makes too much sense. Like you said, it's amazing that we have been in this market now since 2020. It's going on 3 years now, and people have been racking. How do we help unlock the housing market? How do we help create supply? How do we help these home buyers find new homes? How do we not ruin the economy in the process? And there's a simple solution. It's sitting right there on the shelf. All someone needs to do is pull it down and say, yeah, let's do this. And like we talked about, it kind of just has to start at a grassroots level. It needs a portfolio lender to step out and say, you know what, we have a, a book of loans in our portfolio and a bunch of borrowers that we would love to kind of keep to ourselves and build those relationships. If you were a borrower of a bank and the bank said to you, hey, Jason, you got that 3% loan, we'll let you do a substitution of collateral. Where are you going to be banking for the next 30 years, right? You're going to remember who that bank is and you're going to be a loyal customer of that bank. So why the banks aren't out there trying to, solidify these borrower relationships, it just makes so much. I have yet to find really that true reason someone's come up to me and said, well, this is why it can't happen or why it shouldn't happen.
I have while I'm talking to my well-informed mortgage therapist, Michael and I like to go back and forth on theoretical things all the time. The other one that's similar to the say it out loud just makes too much sense principle, which is again maybe a topic for an entirely different podcast, but is the idea of refinancing. And it follows a lot of these same logics. So when you get a refinance, it's a full new application. We have to fully underwrite that borrower again, even against the same collateral, right? So we have the same asset and we're underwriting the new borrower, and we still have to meet this ability to repay rule that says, I'm sorry, but you changed jobs or your income structure is different, and therefore we can't refinance you. I've always thought that makes very little sense in certain sub cases where you have if you're going same investor to same investor, so a Fannie to Fannie loan that's underwritten and serviced and held by the person who's writing the new mortgage. And you're saying, I don't think you can qualify for this $4,000 a month payment. Like you don't, your new income structure, whatever, based on rules, current income, credit, whatever, you no longer qualify for this $4,000 a month payment. And I know you could get this $3,200 a month payment, but you don't qualify for that one either. So I'm going to make you stick with the $4,000 a month payment that I'm holding the bag on. Doesn't make any sense. Why not give them, you're saying I'm going to foreclose on $3,200 a month. The likelihood that I'm going to foreclose on $3,200 a month is too high for my risk appetite. So I'm going to make you keep the $4,000 a month payment that, again, is my responsibility if it forecloses. I don't understand why we're not fast tracking those types of refis where it's a simple solution. We shouldn't even have to look at income. If you want to look at credit, great. Look at credit, look at some of the other underwriting risk variables, but I don't understand why we're looking at income on those situations where you're saying there's a net tangible benefit to the borrower and we're responsible for the payment either way. Why would we want to default on one versus the other? Let's give them a fighting chance to default on the one they have a chance to pay.
It's a great question, Jason. I'll leave that to you and the residential mortgage market to figure that one out.
It will never get done. I just like yelling in the wind.
Yeah.
Well, now that you've heard from two mortgage people or bankers that actually care about the general public and well-being and community will, who would have thought that those existed in the world? But Michael is certainly one of them. I encourage you to connect with him on LinkedIn if you haven't already. If you are in the industry, he's a wonderful follow with lots of great content and thought pieces. It's a great way to find not only this podcast that I will certainly tag him in, but also more content that Michael puts out, which again, I can't encourage you enough to follow, like, and be part of his Substack and other things and thought pieces that he puts together, because it's a great follow. So thank you, Michael.
Thank you, Jason. And thank you for the time today.
My pleasure. I'll talk to you soon.
Thank you for listening to this episode of Finance with Factor. Please remember to like, share, and subscribe. Then if you really like us, open another podcast app, Apple Podcasts, Google Podcasts, Spotify, or really wherever else you enjoy podcasts. Search Finance with Factor and do it again. The more places you like, share, and follow helps our ratings. But that can be our little secret. Have a question about today's episode or an idea for an upcoming episode? Post a comment. For more content, follow Jason Factor on YouTube, Facebook, and Instagram at Finance with Factor. All content discussed on Finance with Factor is self-published by Jason Factor, Senior Loan Officer, NMLS number 1401985. All rates, guidelines, and advice shared on this episode is subject to change. To contact Jason directly or for a full set of disclosures, visit his website at jasonfactor.com.
Jason Factor, NMLS number 1401985. Movement Mortgage supports equal housing opportunity. NMLS number 39179. NMLS, consumeraccess.org.